Hello, everyone, and a warm welcome to today's Major Markets update for Friday, October the 20th, 2023. This is a re-recording from what I did earlier today because the recording got corrupted. The audio was weird and the video itself looked weird. So apologize, I had to redo it. And please refrain from sending me emails asking where the update is. If all my members would do that, I would have hundreds of emails in my inbox. You will always get the update unless I state it otherwise. If I don't state before, there will be no update. The update will be there, but sometimes it will be a little later. Things happen, okay? In this case, the recording got corrupted for whatever reason. Or life gets in between. My family comes first, of course. Just like yesterday, I was supposed to have a phone call, but I got locked out of the house. It happens. So please refrain from doing that. I appreciate your enthusiasm, but unless you don't get anything by Sunday midnight, you will always get it, but it's not always at the exact same time. And by the way, the markets are closed over the weekend anyway, so what's the rush? All right? Please always think further ahead than yourself. Also take me into consideration that I have many members and I don't need to have hundreds of emails. That said, our preferred wave count has always been that we are in a larger counter trend rally B wave. The question is, has this B wave topped? Yes or no? Already in October last year, we were looking for about 4,300, 4,400. And we exceeded it. We got to almost 4,700. Since the July top, we've then postulated that it could be possible to consider a final fifth wave to 5,034. All right, this was our alternative. Within the B wave and this alternative, we could definitely postulate that we would see another rally to about 4,800, right? That would have been really nice because then we would have 5 waves up since the March low. Even for a C wave within a B wave, that would be picture perfect. But C waves don't have to be 5 waves, especially not in a counter trend rally. We also knew that this alternative would fall apart below certain key levels. The first one was, of course, the September-October lows. The second one is about 4185 to about 4100. All right. This Elliott wave count has always remained our alternative. All right. But the green wave 5 or red wave 3 was still possible. And red wave 3 could still be all of the B wave top. Okay. Then we had a 1, 2 and a 1, 2, 3, 4, 5. And we preferred it as there were only 3 waves lower from the green wave 3 top, okay, A, B, C. So shorter term, that's what we were looking for, but we knew our cutoff levels, all right? That's the beauty of the Elliott wave. And you have to give it a weighing that is, of course, based on personal opinion, in the sense that I don't have any facts to go by to say this is a must-happen scenario. You simply look at the price levels that will break higher or break lower to validate or invalidate our preferred opinion. But even the rally to 4,800 would still fit within a larger B wave. The B wave would in that case simply be higher than what we knew in October. That's simply forecasting the weather. The weather can be forecasted 2 weeks ahead of time and saying it's going to rain on Tuesday. But if the rain then falls on Wednesday or Thursday, it's still a pretty darn good forecast from 2 weeks ago. But that forecast will be tuned, of course, to perfection the closer we get to Tuesday, Wednesday, Thursday, right? So that's what we're doing as well. As more and more data becomes available, it's more and more for the markets, so does it for the weather, the barometric pressure, the wind speeds, the wind direction, temperature, humidity. All those things, of course, continuously morph and evolve, so you can update your weather forecast. There's nothing different with the financial markets because both the weather/climate and the stock market are complex systems. And complex systems cannot be predicted in the future. You can't. You can make a forecast about it, but that forecast is, of course, dynamic. It constantly changes because the system changes, right? That's really all there is to it. So once you understand that concept, it doesn't mean that we're always wrong about the markets. Well, we are till we prove them right. but you can, of course, make very good, well-educated guesses based on all these parameters. That said, it really looks like that rally to 4,800 is now the least likely scenario. I also wanted to point out the Dow Jones oil relationship. I've pointed this one out before from a bigger picture perspective. So the bigger picture perspective is this is part of a P wave, potentially to 4,800, most likely not going to see that anymore. We are in the starting gates of the C of the E wave, A wave, sorry. The Dow Jones oil relationship was presented by Tom McClellan from McClellan Oscillator. It's free of charge. You can look it up on his website. And he found that there's a 10-year lag in these two assets, that oil peaks and bottoms around 10 years before the Dow Jones does. So oil topped in January of 2012. The Dow Jones topped in January 2022. Picture perfect. Since 2012, it then got sideways for about 2 years, crashed in 2014. 10 years forward, there will be a crash in 2014, which would also match with Gahn, who says that 2024 will be a panic year. Now, again, it's not exactly to the month always, but you kind of can see you are kind of like here, and we could be setting up for now 1, 2, 1, 2, 1, 2 setups before the final third wave really happens. We're not there yet, all right? Now, seasonality is also something that we track as a roadmap, but it doesn't always follow the market very well. What we did find is that October is kind of choppy, and we should see a low somewhere mid to late October before we rally. Okay, it doesn't have to happen. It's just something that we kind of keep in the back of our minds, and definitely don't hang our heads up on this one. Now, these are all the rules that you need to listen to for trading, of course, because whatever I say, your trading is still quite different. Now, allow me to explain the complexity that we're currently dealing with in the markets. This is the NASDAQ. The NASDAQ topped here in July. Since then, we've only seen 3 waves down and 3 waves up on all 4 legs that we're currently, well, 5th one we're now seeing. The leg lower from July into August was 3 waves. There, I have no other way than counting this as 3 waves lower. Clearly 3 waves back up. It's all ABC. And then into the September low, also 3 waves lower. I cannot count it any other way, whatever method I use. And then we had overlap. We did not only overlap, of course, with the August low, we also overlapped here with the early September low. That was our key level to say it's not going to be an impulse lower. Remember, the market can move either in an impulse or a diagonal. Both are a motive wave. Well, the impulse is off the table because wave 4 and wave 1 are not allowed to overlap. Even if this is 1 in green and this is 4 in green, we have overlap, so not allowed. So the only way to resolve this nightmarish mess since July is ABCs, ABCs, ABCs. And ABCs are the hardest to forecast and track and trade because they are allowed to overlap. Now, within the ABCs, we have, of course, 5 waves for the C waves. So that matches relatively well. A 1, 2, 3, 4, 5 for this green wave C. Okay, 1, 2, 3, 4, 5 for this green wave C. But then I'm missing a green 4 and 5. Now, we thought this could have been a failed 5th wave. It's never my favorite, but I believe this futures market, especially for the SP 500, did make a lower low. So we're kind of at that stage of the case of the missing wave. Is it dog wags tail or tail wags dog type of thing? It has happened before. The NASDAQ and NASDAQ 100 futures market didn't make a lower low, though it came frightening close. So I was about satisfied with it. But then if I now look at the cash market and where we are, this doesn't look good from a 5-wave up perspective since the September low. So we're stuck with all these ABCs, and that's very unfortunate. It's just the way it is. So I'm explaining the market, and that with ABCs, forecasting becomes more complicated, especially when we start seeing overlap, which then tells us this is not an impulse lower. If it's not an impulse lower, most logical thing is to assume it's corrective. But diagonals are overlapping ABCs most of the time. Thus, we can have a ending diagonal motive wave lower, leading diagonal, sorry. So not an impulse, not an impulse, not an impulse, but we can still have topped. That is really the difficult part here. Closer to home, on Friday, we said that the market would go up, down, up, I believe it was, and that's what it did. And by Wednesday, we were thrown a curveball as we expected a rally, and we've been dropping since. Again, I can't get it right all the time. I thought it was pretty good to get Monday and Tuesday right, and then it started dropping, and it's dropped below key levels. And as you can see here, we're right here at about 12,940, I believe it is, and we go below it, then we know this is not a first wave higher, but this was a tricky C wave. This will count different on the S&P 500. Allow me to explain that later. Now, the alternative is that we're still in a fourth wave, okay? The alternative, this is still a fourth wave as shown, and we're dealing with a double zigzag, okay? Then this is A, B, C, that's W, right? And then a X and a Y. So then we have A, B, C, A, B, C. So the C wave is then subdividing again. That is pretty much the message that it's telling us. So if the NASDAQ goes below 12,260 at any time, done deal, B wave top is complete, all right? B wave top is complete. And also here you can see our preferred scenario was for a 4 and a 5. It's still possible if we hold, I would say, above 12,600 on the NASDAQ, okay? So we're still in this wave 4 target. So then this would become a double zigzag. So allow me to explain this double zigzag. Okay, double zigzags cannot be known beforehand. And here we then have 3 waves lower for A. I cannot, again, for the NASDAQ 100, count it any other way than 3 waves lower. 3 waves back up. Again, 3 waves lower, also for the NASDAQ 100. 1, 2, 1, 2. And then we have another 1, 2, 3, 4, 3, 4, 5. That's A, B, C up for B. And then another C wave lower, which is currently underway. This C wave lower targets anywhere between 14,200 and I would say 13,900. You can see we have some nice confluence. And even if we bottom out here at 13,900, we can still target 16,000. But then the market is going to take a detour, okay? A very nasty double zigzag complex correction. So it's still possible, but be careful, it might not be the case. And we have, of course, the NASDAQ telling us, because we're getting very close already, it's only less than 700 points away, to then tell us this is not going to be a fifth wave, even though the NASDAQ 100 might bottom above it. Please remember. So that's our alternative for now. So some might count it as 1, 2, 3, 4, 5, like this. It's possible that this is the leading diagonal. The wave 3 is kind of short. Okay, again, we only have 3 waves lower. It's all ABCs, nasty. And we bottom again somewhere in the same target zone for this wave 1 as we would do for this wave 4. So then, of course, both the potential fifth wave higher and the second wave higher can be longed, so to say, but be aware that here we get the third wave crash for the larger C wave, and here we're going to go to new uptrend highs. Alternatively, and this is, I think, a very elegant way to put the diagonal into a better spot, and I'll show you that for the S&P 500 and Dow Jones, how this better aligns. So then we have wave 1, wave 2, and then wave 3 is subdividing ABC. We get a wave 4 and a wave 5. Okay. Again, you can see the same target zone for this wave 3, about 13,900, 14,200. Okay, 13,900, 14,200. 13,900, 14,200. Okay, so from there, I think we would see a strong reaction. We break below all these levels, we're going to start the crash wave already. But again, you can see 13,900, 14,200 looks a reasonable bottom zone. In this case, we'll get a wave 4 and a wave 5. I like it. It's quite elegant. It is a more protracted, more pronounced, better filled in leading diagonal first wave. Here's the Dow Jones. The Dow Jones also overlapped, right? Again, we had overlap here with this wave A, B, 1, 2, and we counted it as followed: 1, 2, 3, 4, 3, 4, 5. Now, if we were wrong by 1 wave degree, just 1 wave degree, that the orange 3 and orange 4 were in this candle, but this candle, then this was 3, this is 4. Okay, no overlap with this wave 1. Okay, in gray, it's 1 degree lower fourth wave. We get 5 of 3, 4, and 5. Okay, so that matches then quite nicely with this. Okay, I like it. I honestly like it. If we, of course, start rallying, we bottom and rally again above much higher levels, we'll go to the alternative of the double zigzag. But please remember, this is now a very valid wave count. Okay, so then what we would see is this is ABC, and then I would simply count this as, okay, ABC. I would count this as, of course, 4, and then here we're going to get 5 of C of 4, and this is then 3. So this is now going to be our alternative. Okay, so this is 4, and this is 3, this is 4. Okay, no overlap once again, and then we're going to go into 5, and then we still get this one, but this is now our alternative. Okay, there. So we're going to track now, see if we're going to get 3, 4, and 5, because that would then, of course, be wave 1 for the larger C wave. Okay, so also here we expect a bottom pretty soon, around 32,500, 32,750, and then a bounce and then a drop. Or, sorry, we're going to instantly rally to about the same target zone. Okay, it's about the same target zone there, and then we're going to boom, rally like that. So we'll know soon enough, but again, we can clearly see this is not a bull market. This is all we can assess a counter trend rally since the October lows. This is not a bull market. Bull markets don't behave like this. This is nasty overlapping, SHIT. So this is then the wave count we were tracking for the S&P 500, where we had the wave 5, and then 5 waves higher on the daily time frame as well as the hourly time frame. Okay, but we can resolve that because the market didn't go above 44.01. I really wanted to have it go above 44.01, even more so above 44.35 to trigger that third wave that we were tracking. So the way to resolve this is that wave 3 here in green bottomed already in September, and that wave 4 became an A, B, C. The decline here was 3 waves. This was a little ugly decline on the hourly time frame, counted better as an A, B, C, and you can clearly also see it. Then we have 5 waves up, 1, 2, 3, 4, 5. C waves are, as I said, 9 or 10 times 5 waves. So we have wave 1, wave 2, wave 1 of 3, 2 of 3, 1, 2, 3, 4, 3, A, B, C. A very complex fourth wave. This would then be a irregular, expanded flat. That is definitely the hallmark of a fourth wave. Now a 5 of 3, 4, and 5. Okay? That is then the potential. And as you can see, we're starting to overlap quite soon here with what would potentially be, of course, our level. All right, that's overlap. Because some would say, okay, this is then 1, and this is 2, okay, and this is then 3, and this is then 4, right? That's what we would suggest, but we cannot overlap. Okay, we cannot. There. Voila. So this is now the preferred wave count, and we simply cannot overlap with that 42. We're getting so awfully close. Don't want to see it. Now, semiconductors can still also rally. Again, also here we would then have this double zigzag, ABC, ABC. As long as we stay above 31.75, it is possible. Below 31.75, top is in for this larger B wave. And then I'm going to count it similarly like a 1, 2, 3, 4, 5, or like the NASDAQ 100 as well. 1, 2, and then A, B, C for 3, and then 4, and then 5. Okay? I know it would match it all with seasonality, all that good stuff, but seasonality is really the last go-to piece of information. This one has been reasonably nice, I must admit. Early in October, it looked really good for a bottom in place, but we had to rally above 180. We had the alternative for the wave 4 high, and that's what we got. And now, in my humble opinion, we're subdividing lower for this wave 5 of 1. Alternatively, it is, of course, a a D wave, no, where is it? Sorry, not that one. Here, so 3, 4, 5. For a B wave and then a C wave. Okay, so then we have A, B, C for a pretty much irregular flat B wave, and then another C wave to go. But I don't want to become too optimistically bullish. And first and foremost, let's track the green 3, green 4, green 5. As you can see here, we should see a bottom somewhere around, I would say, 160 plus or minus $2 for 5 of 1. We should complete green 3 here pretty soon, bounce back here to about 168, down to about 161 plus or minus $1 for 5 is 1, and then rally all the way back here, of course, to this midline, I would say at around 180. Okay, this is then a nice clean impulse lower. Wave 3 fell a little bit short. It should have bottomed here between 163, 167. But clearly, wave 3 was longer than wave 1. Wave 4 did go where it's back to where it should be. And now we pretty much get a extended fifth wave. Okay, but a fifth wave that's about equal to 5 length of 1. Okay, that's, as you can see here, 76.4 plus 100% is, of course, 176.4, with 100% being the equal length of 1. And that should be 1, and then 2, and then we're going to get 3, 4, and 5. Alternatively, as I said, then we have a C wave lower. Okay, 3, 4, 1, 2, 3, 4, 5. Same target zone, and then a big fat bounce. So also this one tells us once we bottomed, we're either going to see a rally to about 180 or a rally to 198. We'll deal with it when we get there. I cannot, of course, already prepare myself for either 198 or 180. That's, of course, nonsense. We have to track it. But we do know once we bottom here, we would see a pretty decent rally. Okay, that's pretty good. So please keep that in mind for the IWM. And I just simply cannot discern, because this price action is so messy and sideways and overlapping, that bigger picture-wise, these are the only two alternatives or interpretations I have, with one preferred, one alternative. I don't know which one it is. I simply have to pick one as a preferred one. Okay, that's really all there is to it. I have no objective method to tell me which one is preferred versus which one is alternative. There's just no way. This also tells you that, again, positive divergence is only a condition and not a trigger, because when we got the first positive divergence, or even the third one, which was at 175, and look where we are now, 166. So it is simply a condition, not a trigger, and it can always be erased. And we might see even quadruple positive divergence, or sequential, whatever the number is after quadruple positive divergence. It's crazy. It just goes to show it's a condition, not a trigger. All right. And of course, it's really nice to see it work. And it does work most of the time in the bull market. In the bear market, it is apparently and often ignored. Just as negative divergence is often ignored in bull markets, positive divergence is often ignored in bear markets. It's simply something to chalk it up as FYI for your information. And that brings the IWM all the way back here to where we were in June and October last year. And that just shows you the state of the economy of the United States, because these are much more economic sensitive than, of course, the mega cap driven indexes like the SP 500, the NASDAQ 100. All right. So in summary, again, it's all been ABC slower. Preferred wave count is now for a B wave top. Yes, we were looking for the potential to still go to 4,800 for a fourth wave, but those odds are diminishing. Below 12,300 on the NASDAQ, top is in, loud and clear. If we stall at around 12,600, it is still possible to go to new uptrend highs. Then, according to the NASDAQ 100, we have a double zigzag to content ourselves with AB, ABC. All right, that would be a WXY, I believe it is in true terms. And then we can still rally higher, but it's starting to get tricky. Below 13,900, I think on the NASDAQ 100 is going to be, yeah, I don't want to see it. The alternative here is we bottom again in this 13,900, 14,200 zone. We rally and then we crash. Okay, same here. We bottom out at around 14,200, 13,900. Then we rally. Or are we going to get this more protracted, better filled in impulse? Okay, as we see here, 3, 4, 5. I like it a lot. This is quite nice. It matches quite well with the Dow Jones like this, 345. Okay. Alternatively, the Dow Jones is in this one, and then we rally. So also here, the Dow Jones is looking for a low at around 32,250, 32,750, and then we rally, or we're gonna just bounce and then we drop. Okay, to be determined. Same here for the SP 500. We did get 5 waves up from the late September, early October lows thereabouts, but we did not go above 44.1 or even 44.35. Right, that was really what I wanted to see. So now with current price action so close to the September lows, this wave 4 here is not yet done. So it starts to look more like this 3, 4, and 5 potential. Okay. Please be aware of it. So now this is our preferred wave count. And then the alternative is that we are going to switch this also to a double zigzag, similar to what we have here for the semiconductors. But if the semiconductors go below 3150, lights out. Same here for the S&P 500. I don't want to see it actually go below 4185, I believe it is, and really 4,000 something. It's all lights out. All right, then it's really topping. IWM, I think we're going to get the 345 here in green for a completion of an impulse lower since July. That then strongly suggests a first wave of a larger C wave. Alternatively, it is only a C wave of a B wave, and we're still going to go back up to the highs we've now reached 3 times before. Very complex. I can't discern which of the two is the most likely, but I do go with the impulse lower, and that we're only going to see a bounce to about 180 instead of a rally to 198. Last but not least, if you're really interested in markets that are rallying, please consider gold. Please consider my gold package. You'll get weekly updates on gold, GLD, GDX, GDXG. I think they can double. Much more upside versus the indexes. And of course, Bitcoin. Bitcoin is, in my humble opinion, very close and on the cusp of breaking out and going to about, I would say, 100 to 150,000. So also that one has a lot of upside potential. So please consider that. If you don't like working to the downside, then please consider these two, because they have, in my humble opinion, a lot of upside left. And so far, we've not been wrong on either. Take care. Trade safe. Again, apologize for the late notice. Technical difficulties happen. Don't worry about it. No need to send out emails. The stuff will arrive. Things just happen. Take care. Trade safe. Catch you all next week.